Hey, this is Charles Freeman, and I'm a chartered financial analyst. And I wanted to talk a little bit about the market rally we've had this week. The Federal Reserve suggested earlier in the week that they would consider lowering interest rates given all of the trade rhetoric and the deterioration in trade talks. And I think that should be taken as a word of caution, even though the market has been rallying off of that information. Essentially, that I think the optimism is somewhat misplaced. The market has been going down throughout May because trade talks have deteriorated. We've had a softening of economic numbers, and all of those things are suggest that growth is slowing, and we could be in for lower earnings kind of going forward, given a lot of input costs are up. So, and when the Fed is lowering rates, that's actually not a very positive sign, because what they're saying is they really need to try to stimulate the economy given some of these bad things that are happening. So the rally is sort of based off of the wrong reasons, in my opinion. And so I think we really need to take a word of or have some caution when we look at that. One of the things, I think the reason why there's so much faith in the Fed is that given the Great Recession, Ben Bernanke and the Fed essentially sort of saved our economy. And since then, in my opinion, the Fed has been somewhat deified, and that basically anytime we run into a rough patch or the market looks like it might be going down, the Fed kind of steps in and says they will accommodate and provide some stimulus measures of some kind, and then the market rallies off of that. Unfortunately, I think putting so much faith in one institution is incredibly reckless, and it's a mistake. So I'm afraid that this sort of insane optimism we have based on what the Fed does is a gigantic red flag. So, but I hope this has been helpful. This is Charles Freeman with Adapt First Investments, and we'll see you next week.